Welcome. In Phase C, you watched actual costs pile up in work in process and flow into cost of goods manufactured. Now we ask the real question: were those costs reasonable? That is what variance analysis answers. Over the next few minutes, you will learn how to compare what actually happened against what should have happened, and how to point each difference at the person who can fix it. Grab your coffee and let us dig in. Here is where we are headed. First, you will explain the sign convention that tells you when a variance is favorable or unfavorable. Then you will apply the formulas for material and labor variances and learn who is accountable for each. Next, you will identify the trickier overhead variances, splitting them into spending, efficiency, and volume. You will also learn how to decide which variances are worth investigating and what their root causes tend to be. Finally, you will record how variances are cleared off the books at period end. Before any formula, lock in one rule because everything else hangs on it. Every variance is actual performance minus standard. When actual exceeds standard, you spent more than you should have, and that is unfavorable. When actual comes in below standard, you spent less, and that is favorable. The standard you compare against is always the flexible budget standard, meaning what the output you actually produced should have cost. Get this convention straight, and the 9 formulas that follow become almost intuitive. Miss it, and you will praise a cost overrun and panic over a saving. Let us start with materials, and the first thing a manager wants to know is whether we paid a fair price. The material price variance answers exactly that. You take the actual price per unit, subtract the standard price, and multiply by the actual quantity purchased. If the actual price was lower than standard, it is favorable. The causes are telling: volume discounts, spot market buying, supplier price changes, or a quality difference in what was bought. Because all of these sit in the buyer's hands, procurement owns this variance. It is your earliest signal that purchasing performance has shifted. Paying the right price is only half the story. The material usage variance asks whether the factory floor used the right amount of material. Here you take the actual quantity used, subtract the standard quantity allowed for the output you made, and multiply by the standard price. Standard quantity allowed is simply the standard per unit times the actual units produced. Favorable means you used less than expected. When it goes unfavorable, the usual suspects are waste, theft, yield problems, an inaccurate bill of materials, or poor material quality. Notice this one belongs to production, not purchasing. Splitting price from usage is what lets you hold the right team accountable. When a product blends several materials, the usage variance splits one level deeper. The mix variance asks whether you used inputs in the standard proportion, comparing the actual mix to the standard mix, times total actual input, times the standard price of each ingredient. The yield variance asks whether the actual output you obtained matched the standard yield from those inputs. Here is the elegant part: mix and yield together add up to the total usage variance. So if your blend drifted or your yield slipped, these two variances tell you which one, and by how much. That precision is what turns a vague overrun into a fixable problem. Now move from materials to people. The labor rate variance mirrors the material price variance. You take the actual hourly rate, subtract the standard rate, and multiply by the actual hours worked. Favorable when you paid below standard. What drives it? Assigning higher or lower skilled workers than the standard assumes, overtime premiums, or a wage increase that has not yet been built into the standard. Responsibility here is shared between human resources, who set pay, and production supervision, who decide which workers staff each job. It is the wage side of labor cost, kept separate from how those hours were spent. The companion to the rate variance is the labor efficiency variance, the labor twin of material usage. You take the actual hours worked, subtract the standard hours allowed for the actual output, and multiply by the standard rate. Standard hours allowed is the standard per unit times the units produced. Favorable means the team beat the clock. When it turns unfavorable, look at machine downtime, poor scheduling, inadequate training, or general production disruptions. Sometimes it goes favorable because a crew found a better method than the standard assumed. This one sits squarely with production management because they control how the hours actually get used. Here is a detail most people overlook. Sometimes workers are paid but not producing because a machine broke down or they are waiting for materials. That is idle time, and it is a subset of the efficiency variance. You isolate it as idle hours times the standard rate, and it is always unfavorable because you are paying for nothing. Why bother separating it? Because once you strip idle time out, the remaining efficiency variance shows true labor productivity, how well people worked when they actually had work to do. Lumping the two together would unfairly blame your crew for a maintenance failure. Overhead is the most complex piece, so we take it carefully, starting with the variable part. The variable overhead spending variance asks whether the rate you paid for things like utilities and supplies match standard. It is the actual variable overhead, less the actual hours times the standard rate. Price increases or spending inefficiencies drive it. The variable overhead efficiency variance asks whether the allocation base, usually labor hours, was used efficiently. It is actual hours minus standard hours allowed, times the standard rate. Here is the key insight. When labor hours drive the allocation, this variance shares its root cause with the labor efficiency variance. Fixed overhead splits differently. The fixed overhead spending variance simply compares actual fixed overhead to what was budgeted, catching surprises in rent, depreciation, supervisory salaries, or insurance. Straightforward. The volume variance is the subtle one. It compares budgeted fixed overhead to applied fixed overhead, where applied equals the standard fixed rate times standard hours allowed for actual output. It goes favorable when you produce more units than budgeted, because more units absorb the same fixed cost. This variance exists only for fixed costs, and only because we apply them at a predetermined rate based on budgeted volume. It measures capacity use, not spending discipline. Step back and see the whole map. Materials give you price and usage, with mix and yield splitting usage further. Labor gives you rate and efficiency, with idle time carved out of efficiency. Overhead gives you four: variable spending, variable efficiency, fixed spending, and fixed volume. Total material variance is price plus usage. Total labor variance is rate plus efficiency. Total overhead variance is actual overhead minus applied overhead, which is just your over or under applied balance. Add them all, and you get the total manufacturing variance, the gap between what production actually cost and what the same output should have cost at standard. Not every variance deserves a meeting. The cost of investigating must be weighed against the expected benefit, so companies set thresholds, either an absolute dollar amount or a percentage of standard, commonly 5 to 10% for materials and labor. Once a variance clears the threshold, you classify its root cause into one of four buckets. It may be measurement error, where the cost was simply recorded wrong, so you correct the entry. It may be standard error, where the standard itself is outdated, so you update it. It may be random variation within the expected range, needing no action. Or it may be real operating inefficiency, demanding corrective action like retraining or a supplier change. Finally, variances have to land somewhere. Reports go to the manager who owns each cost element: procurement for material price, production for usage and labor efficiency, and significant ones get aired in the monthly review. At period end, you dispose of them. If the total variance is immaterial, less than 10% of total applied costs, you close it entirely to cost of goods sold. If it is material, you allocate it proportionally across ending inventory, that is raw materials, work in process and finished goods, and cost of goods sold based on their relative balances. That allocation keeps the balance sheet reflecting actual cost, not standard. Let us pull the threads together. Remember the convention: actual above standard is unfavorable. Materials and labor each split into a price or rate variance and a usage or efficiency variance, and each half points to a different owner. Overhead breaks into 4 pieces, with the volume variance unique to fixed costs. Investigate only what clears your threshold, and classify each one by root cause before acting. At period end, immaterial variances close to cost of goods sold, while material ones get allocated across inventory and COGS next. In Phase E, we move to inventory control and valuation. Thank you for completing this section on variance analysis.